Hello Freedom Builders, and welcome back to the channel for another Stock of the Week video. Today we're going to look at a company that I'm pretty sure a lot of you have never heard about, because they're not really the kind of company that are delivering products to normal consumers. They're called Booz Allen Hamilton, strategy and technology consultants. And I don't know about you, but this is about as boring as it gets. You can see the most exciting picture I was able to pull off when I searched for the headquarters was this, and this is actually their logo. So there's no fancy stuff about this, but the question is, do we need fancy and do we need sexy when it comes to investing? If you have followed me for a while, you know that I'm a big fan of this old quote saying that investing should be just about as exciting as watching paint dry. And, well, in my opinion, Booz Allen Hamilton, when looking at it, is just about as boring as looking at paint dry. But that doesn't mean it can't be a good investment. So let's have a look at it. And we have here the normal things that I'm going through: the qualitatives, basic fundamentals, dividend, insiders, price value, short-term view, and of course the price chart. So let's start out and see if Booz Allen is actually a company that should find its way into my portfolio. Well, if we look at the price chart just for a start, you can see that this is about as good as it gets. This is what we want. We want a steady upline without too much fluctuating price. We just want a price, a stock price that just keeps going up, maybe takes a bit of a break once in a while. This is great. This is actually what I want. The question is it too expensive now? Has it gone up too much? I am a trend follower, and that means that I don't have to buy at a low price. I know that sometimes I can buy at a high price after a stock has gone up 100%, and still I can make money because it can easily go up 100 or 1,000% more. The question is if Booz Allen is such a company. But just looking at the chart, this is pretty much what I want. And if you have seen my my videos about learning my strategy, you can also see for a stock to be in the green zone for us, we wanted to do better than the overall market, and we want the RSI showing that we are in an uptrend. And I don't think we need the indicators here to see that we are in an uptrend. And since we got our first buy signal here in the spring of 18, that was around $38, and now it is doubled in price. So that is great. The question is, can it double again? Let's have a look at some of the fundamentals. Oh, by the way, let's first have a look at their website, because their website is actually a bit more exciting and nice than I would have expected by looking at their logo and their headquarters. But what can we learn from this? Well, the Booz Allen Hamilton, when we look at their expertise, we don't learn much here. We don't learn much here in any companies pretty much, because these are kind of their values, their mission statements. Expertise, we are building value and opportunity by investing in cybersecurity and that. We don't learn much about the company here. Consulting, it pretty much says that they are great at what they're doing. But when we go into the markets, we get a bit wiser as to what they actually do for a living. Because we can see that they are servicing civil government, meaning that they are tech management and tech consulting analysts, engineering, digital solutions, and so on, cyber expertise, cyber security, and they're doing that for United States government, for other international governments, and also some very large corporations. So they are pretty much making sure that, for instance, the United States Army, that when they go into combat, they are doing a lot of the infrastructure that can protect the soldiers. Also, a lot of the supporting of the soldiers' families and so on. So that is actually quite neat. But you can go into the website just called boozallen.com, and in here you can read a lot about them. Okay. Another thing I normally look at when I look at a company like this and searching around on different websites is if it is very active in acquisitions. Are they buying up? How are they growing? Are they buying up a lot of companies? And here on the Crunchbase we can see that, let's just see if we can drag this one up. Here you can see that they have been buying some companies, but you can see here on the date that was in 2014, 12, 15. Well, now we have a question mark here, but again in 16 and 17. So the latest acquisition they had was in 2017, a company called Morphic Cybersecurity. And that is pretty much in a great line with what they do today. But they haven't acquired any companies other than that. So that is 2.5 years ago. So that they're not spending money there, but I'll get back to how they grow then. So let's have a look at the fundamentals. As you can see, the quality of the company here on Stockopedia, and if you're new to the channel, Stockopedia is my favorite go-to tool when it comes to finding a very big overview of the company, a very quick overview. They have these ratings on quality ratings, value and momentum, and they also have a stock rating, stock rank, which is some sort of calculating of these three together. And I used this just to get a very quick glance as to if this is a company I would like to look further into. And we can see they have great value, they have great momentum, and this is not just price momentum, that is also momentum in earnings and different key numbers. And they have a very high stock rank where 99 is the highest, and so they are worth looking more into, definitely. We can also see that the value ranking is a bit low, and that might be due to the very large price move they have made over the last year or so. So let's have a look into it. We can see that the PEG ratio, meaning the current PE ratio divided by the expected growth next year, is 2. That is within my limits. I like 2 to be the upper boundary as to where I go in. I like it to be 2 or below here. We can also see that the dividend yield is 1.55, which might seem a bit low. That's actually the dividend yield for next year. The dividend yield this year is more around 1%. I'll get back to that. But that might be a bit low, but they are growing the dividend quite heavily in these years. We can see that the price to book value is quite high, meaning that the price has gone up way faster than the book value, than the intrinsic value of the company. We can also see that the price to free cash flow is high. Price to sale is fair. I like it down around 1 or below, but 1.55 is fair. And EV to EBITDA, not a bit too high for me as well. So these are some of the reasons why it's only getting a value of 32. I should also say that if you don't know Stockopedia, I'll put a link here below, and you can get a 2 weeks free trial, and then if you use that link you can get a 25% discount on the product. It is not the cheapest of products, so if you only have a portfolio of $3,000 or $5,000 or $10,000, this might not be for you. But at least you can try it out for free. I think it's a 2 weeks trial. But I really like it. And if your portfolio is just a bit larger than that, this could easily be worth the money. Okay, let's go into here. Return on capital, return on equity, very, very nice. Petrosky score is at 7. I like it 6 or above, so that is fine. We can see that the earnings per share is growing, just a nice and steady line from left to right. That's great. Have been a couple of negative years here though, but overall it looks good. Okay, operating cash flow is also quite nice. It's getting better, and the free cash flow as well. Then we come to the dividend, and that is where I know a lot of you have your focus, and you can see that the dividend is right now, let's see here, dividend per share and dividend yield, these are the two. The dividend yield right now is just around 1%. But if you look at how much it grows, then they have had tremendous dividend growth. So if they can keep this one up, You can see right now you are at around 1%, but if you are a hardcore dividend investor, this could, in a few years, if they keep this dividend growth up, this could actually mean that you could quite quickly come up around 2, 3, maybe 4%. So maybe not the best dividend right now, but if you are a dividend investor, you should look for the potential here, and that is actually quite great. Another thing I look for, as you know, is the dividend cover, meaning how many times does the earnings per share cover the dividend payment, and they are well covered. I like 2 or above, and this is around 3. So, and it has been, well, it has dropped a bit here, but it is fairly stable up around 2.8, 3.4, so, and doesn't look to drop too dramatically. We can also see that the free cash flow, which is actually the money that should be paying for the dividend, can easily pay for the dividend. So I'm not concerned at all there. Interest coverage, they can cover their interest payments right now with their earnings per share, so that is great. They do have quite a lot of debt though, a couple of billions I think it is. Let's just see. Well, the net debt is up around 1.4 billion dollars. So if at some point interest should go up, or they should be in some sort of trouble financing their different acquisitions or their internal growth, then this could be kind of a burden for them. But right now, I'm not concerned about that either. So just the quick overview here. I actually like the fundamentals here. Value indicates that it might be a bit expensive, but if you just look at graphical history here, we can see the light blue here is the estimates, and that is pretty much just going upwards here. We can see that the analysts are saying it's a buy, and we can see that the estimates for 20 and 21 are just slightly moving upwards here, and that is what we like to see, that the estimates are getting better and better. If we just take a look at the SACs, as you know I'm a big fan of, we can see that the broker recommendations have been, they were going up here to 17, then they dropped massively. I'm not sure why, although it is a scale from 1 to 5, and they were not even at 2.5, so it was still a little buy here, but it did drop quite dramatically. And then it went up, and for the last 6 months or so, it has been decreasing again. So it is not that it is a completely certain indicator, but if the broker recommendations are bad, then normally the price could take a bit of a rest, at least, sometimes dropping. But you can see here that the big drop here didn't result in a big drop in price. It just resulted in a fairly long period where the price went sideways. But again, if you are a pure dividend investor, then a sideways price shouldn't concern you too much. It has gone up way faster after that, but if you're just collecting the dividends, then a sideways market for a year or so shouldn't be of any concern. If we are looking at the earnings per share surprises, which I also like to see, you can see that it has a SAC rank of 2, and I do like 1, 2, or 3 here. That means that they are quite stable, positive surprises, if I could call it that, meaning that they are good at surprising positively. And if you see here since 17, this one might be, there was a negative earnings surprise that might have caused a drop in the broker recommendations there. But since then, they have been positively surprising every single quarter here. So there's nothing really to say to that. Yeah, and the one thing that do concern me a bit, and here I'm going into fast graph, and here we can see that we can see the dividend down here. That is going up, and that is great, and it is estimated to grow even further. if we're looking at the growth, then we can see that it has had over the last 11 years an adjusted earnings growth rate at around 11.15. It has in the first years oscillated fairly okay around this earnings and EPS line. If we look at the last 5 years, we can see that it is also oscillating nicely down here. We can see that it has had an adjusted earnings growth at just below 18% with a normal PE ratio around 20. But the large increase in price, as I mentioned earlier, which has resulted in something that around a 75% growth over the last year or so, has made the stock fairly expensive. And it's not that it can't go up from here, because as I showed you in the graph, it is a good uptrend and we could look for some further upwards movement here. But we also know that in the long run, over the next year, 2 years, 3 years, most stocks have problems staying overvalued. And if we're looking at the forecasting here, we can see, let's see if we just move this one, we can see that they're forecasting 14%, 11%, 13%, and 1% down here in 33 in the growth in earnings. And even though they keep that up, and even if they can keep this very high earnings per share here, then there is, quote unquote, only including the dividends, around 13% in annual return. But if the investors, the large investors, think that they should come down to a more reasonable level, then we could actually see it drop down to maybe 1.5% over the next year, or even -4%. So there should not be much correction downwards before this could be a stock that actually pretty much went sideways for the next year or maybe two. So we have here on a 2 year, we have, if it just drops a single level down here, we have 7.5%. If it drops down to the next blue one, we have 4% per year over the next 2 years. And this is including the dividends. So that is pretty much a company where I would say the big upside is not really there. It's not that it can't go up 10 or 20% quite quickly over a month or a quarter or so, but seeing it over the next year to 2 years, I'm not seeing this as a company where I find some really good potential for growth. And as I mentioned, it doesn't have to be quite price growth, because if they were paying out huge dividends, it doesn't matter too much if the price is just moving sideways. I should say that the dividend yield here at around 1% should be also compared to what we call the shareholder yield. And the shareholder yield is the dividend yield plus the buyback yield, as it is called. So when companies have free cash flow available, they can use it in different ways. They can pay out dividends, but they can also buy back some of their own stocks. And it seems here that they have a buyback yield of around 1.5%, meaning that they're buying up some of their own stocks. So the 1% dividend yield should actually, I'm more a fan personally of looking at the shareholder yield, but that's a bit of a question of temperament. But anyway, I'm not seeing this as a big potential, a big upward potential. Let's say that over the next quarter or 6 months, the price dropped way down, maybe down to 40 or 50, something like that over some time, and we started to see a turn again and some upwards momentum, then I would say there was a way better potential for some upwards growth. But right now, just this picture pretty much make me not want to invest in Booz Allen. But again, if you are a dividend investor, you might have a different feel about that. Okay, quickly, just to round up, we have the short term here. We are in tip ranks right now, and we can see that the analysts are saying that there is, on average, they evaluate as around 5% upside potential. So they pretty much agree with me that there's not a huge upside potential in this one. If you're looking at the stock analysis, it is a 10 though. Analyst, moderate buy, blogger opinion, bullish. Hedge funds activity is increasing, but inside activity, it says nothing really happens here. But let's just have a look at Guru Focus in a second, because a bit happens actually. But that is pretty much, let's say we don't have the highest level of executives here selling. But we do have someone selling a bit. We can see that just a second in the Guru Focus as well. But as you can see, it hasn't been very much. There's not much new sentiment. That's pretty much neutral, and they evaluate the technicals and the fundamentals as being positive. And that is pretty much my opinion about it as well. If we look at the Guru Focus, we can see pretty much the same picture. We can see a good financial strength. We can see some good profitability range, but the valuation is poor, to say it at the least. If we're looking at the insiders here, we can see, it seems a bit more dramatic here, but what we can see and what we should care about is what has happened within the last year. And we just had some selling here recently, and that was, let me just see here, executive president. Yeah, there has been a bit of selling from some of the vice president something here, but it is not something that I would say was dramatic. You could see here that this guy, Link Christopher, he was selling 40,000 shares, and that of course seems like a lot, but it should be compared to how much, I don't even know if it's a he or she, but let's just say it's a he. I don't know, it should be compared to how much he owns, and he owns 43,000 shares, so yeah, well, that is pretty much most of it. So I'm not sure about that one. It's not something that really concerns me. It is not really high numbers. It's not in the hundreds of thousands or millions here. But it is good to take a look at. And of course, this could be a picture of this very high price that has gone up to, because sometimes some of the insiders are also selling, not that because they think it is going to go badly for the company, but because they have a good feeling as to what is a fair value of this company. What is it that I can see on a day-to-day basis that this company should be worth? And there can be a million different reasons to sell, but selling here at this high price seems like an indication that also some of the higher level executives are evaluating that the price might not go much higher. If they had some insights that the price should double over the next quarter or over the next year, they might not be selling right now. But it is hard to know why exactly they're selling. Okay, so that is pretty much the picture here. As I said, it is a good and solid company. And if you want to buy a company that you want for dividends for the next 10 or 20 years, Booz Allen Hamilton might actually be the one to buy. Personally, I am not buying because I do like the dividends, but I do like also to have a lot of growth potential in price, and I simply don't see this here. So my evaluation of this company would be that if you are only a dividend investor and you want something for this certain long-term solid growth, well, go for Booz Allen Hamilton. I don't see any reason why you shouldn't. But if you also want to be into some gains in price, I'm not certain that we're going to see that. I could actually see this one going sideways or maybe even dropping a bit over the next year. And that's not really the kind of company I personally want to be into. But just remember, I'm not a financial advisor, and you should always take your own situation into account, how old you are, how much money, when you might be using the money, and so on and so on. So you should do your own research. That's pretty much it for now. Booz Allen Hamilton, well, maybe it's boring, I don't know. But it is steady, it is solid. And if we are going into some times now with more volatile stock markets, and we have the coronavirus, and we have the some battles in the Middle East and so on, well, Booz Allen Hamilton might actually be a good and solid long-term place to put your money. That's all for now. If you haven't done already, please remember to subscribe to the channel, hit the like notification, the bell notification, every notification you can find down there below the video. And I have put some links in the text below so that you can find some of my favorite tools here. And I guess that's it for now. Take care of your money out there. I'll talk to you again soon. Bye for now.